we've upgraded both Woodside and Santos. So I'll first start with Woodside. We've upgraded to an add from a hold. Basically, much like Santos, a lot of it's just on the share price action that's been happening. We've also slightly increased our longer-term oil price forecast. So really looking at Woodside, it still ranks number 2 behind Oil Search in my preference amongst the large cap oil and gas stocks, but there's no doubting the quality. It is the safest pair of hands in the space. So while I really love the upside of Oil Search, we've talked at length in the past about the fact that all of its operations are obviously in PNG, which is a higher sovereign risk place, and that really does set it apart from Woodside, along with Woodside having a stronger balance sheet and slightly stronger margin. But on that margin, it is pretty exceptional. Woodside EBITDAX margin, which is EBITDA excluding exploration expense, is 72%, which is literally double what the global average is. So, I mean, looking across Exxon, Chevron, Total, Shell, BP, Conoco, I mean, none of them have an EBITDAX margin above 20%. So the fact that Woodside's travelling there above 70%, I really think should see it actually trade on quite a premium to its global peers, but it's actually trading on a discount when you look at EV/EBITDAX of 10 times versus that peer group on an average of 17 times. So it's usually the reverse, where Australian stocks, especially large caps, are quite expensive versus global peers, because we're obviously quite a confined market where a lot of a small pool where a lot of the money that trades here is trapped and can't go overseas, but it's actually trading at a discount to its global peers, which I find really interesting, especially since a lot of them are also seeing diminishing reserve life across their global operations on average. So with all of that, looking at the share price coming back 20%, to me it was one that I've long been thinking of when do we upgrade it, and no one can pick the bottom in oil, but certainly a lot of weakness we've seen so far. You'd have to say that the further downside from here has been significantly reduced. Just on the oil price, a lot of market focus, quite rightly, is on what OPEC are doing, and they're really rationally cutting back on further supply and really seeing good compliance levels across the OPEC members being maintained, which I think will continue into this year. And really the negative being pushed against it is the strength of current shale output. And shale production, certainly what we're seeing monthly figures now around could reach as high as 12 million barrels per day. That's really from activity that happened 3 to 4 months ago. So from the lead time from when CapEx is sunk in shale to when each well comes online. So with that in mind, it's really a flurry of activity that we saw when the oil price was exceptionally strong, not so much a show of resilience or strength from the shale industry versus what's happening right now. And what's happening right now, as we're tracking on Bloomberg, is that the number of DUCs, or drilled uncompleted wells in the US, is absolutely skyrocketing. So it's just reached 8,000 wells, which is the highest it's been in over a decade. And the reason for that, mainly in the last few months, has been that oil price weakness, because the biggest cost center in shale, or the biggest part of their cost structure, is fracking and completing. That's 2/3 of the capex of a well. So while most shale operators usually sign up for longer term drilling contracts, so people look at the rig numbers, but usually even when they're on the back foot, shale producers still keep drilling because they have to contractually. But it's actually the number of wells they're completing that reacts, and I am seeing that supply response building. So that's a positive. OPEC's a positive, and trade talks are obviously a positive. We're hoping that they come through to something more constructive. So all of that in mind, the oil price being crushed, I think just on over exuberance late last year that we talked about, and a supply response that's already building. It all supports my positivity around the oil price. So recapping on Woodside, it's now cheap in my view, trading a discount at a dividend payout ratio of 80% of EPS that it can sustain for a few years before it gets into a capex heavy phase, and a franking credit balance of $2 billion. So we have to see what they do with that. So with a price target of almost $38, I just think it's a nice safe add for the average retail punter. Just on Santos, it's been the worst stock I've ever called in my career, but hopefully not moving the opposite direction to what the share price does this time. So, I've upgraded it to a hold from a sell, long-standing sell, but really the story changed late last year to me when they did take out Quadrant. So that's a very good asset base, mostly on the West Coast, along with some offshore greenfield oil that could really be very accretive. That's a great combination that, other than that oil operation, isn't at all reliant on the oil price. So a lot of the gas production they're picking up from Quadrant is under long-term fixed contracts, and that really helps a massive strategic weakness in Santos, and that is it's over leverage in earnings and valuation to the oil price. So it's certainly shifted some of that, well accretive for earnings and at a reasonable price. So that my view on Santos improved then, but at the same time the share price was above $7 and just to me far too expensive. So now below $6, it certainly looks more like fair value. So, GLNG is still dragging on it. We're just slightly trimmed back activity further for the year ahead, just on the fact that CapEx is still lagging. They're still neglecting GLNG's CSG fields. And that still leads me to think that to keep filling the plant at GLNG, they'll remain acquisitive on the East Coast. So things like Comet Ridge or Senex, I still think are big takeover targets for someone like a Santos. And they're probably going to use their script for that, given how strong it is versus those small juniors. So at this point, I'd be comfortable with that kind of acquisition, given the difference in multiples. But yeah, at the same time, outside of Quadrant and PNG, which has been a source of continued upgrades for Santos and Oil Search, I just think it's covering a bulk of really old, small-scale, expensive assets, plus GLNG, which is a bit inefficient for me in capital deployment, that still keeps it as a hold, not a buy. So Woodside a buy, Santos a hold.